Back up a little bit. There you go. Wave to your fans at home. There- It is showing up. Yep. Yes.
No, there is a downside. It eliminates my swearing. I got to behave. So, all right. People here I recognize that have come to my classes. I call them slow learners. Because I've been doing these classes for over 25 years.
Turn your mic on.
I have on.
It's on? Okay,
Yep.
I need to turn it on.
Oh, this is one minute. All right. That even bums me out even more because sometimes I get a little excited and then all of a sudden it's like, whoa. All right. So there's people here I recognize that have come to the classes for, like I said, I've been doing it for about 25 or more years now. But there's some new faces here. And for those people, I introduce myself. I am, first of all, a financial planner. I hate to disappoint you, but no free meals, no looking at your portfolio at the end of the class and doing what you really need here. That's not what this class is all about. This is education. It really is informative. It's trying to take what I've learned about investing, what I have done as an investor, and my experiences with investing, and all the things that I've learned in order to be qualified to answer questions and teach this class is my sharing that with you as kind of like my way of getting back to the world, which has really blessed me. I have been exceedingly fortunate in my life. I know how people struggle financially. And I was blessed with two awesome parents that didn't have much money. I don't think my dad ever earned $30,000 in a year. He taught at First High School. And parochial school teachers aren't overpaid at all. So we lived on his salary, and I have five brothers and sisters. So my parents taught us as children how to make a quarter really last. We weren't born with silver spoons in our mouth, and we would learn financial responsibility from a very young age. Um, and so I had that foundation growing up. Money doesn't grow on trees. We're not entitled to have all of these things we want. And other people are going to have way more stuff than you, but that doesn't mean they're happy. It doesn't even mean they really own it because a lot of times the bank owns that. I had a really sound foundation as a young person growing up. And next, I was taught the ethics of work. That like money is the byproduct of the use of your talents, abilities in life. Once again, you're not entitled to wealth. It has to be earned. It has to be achieved. It's the result of hard work and effort. And so I learned that. So you combine those two things, and I was off to a great start as a young person. So from there, I went on to college and worked my way through college. Was lucky enough to fall into a small business, which I bought out of college, and had nothing to do with finances and nothing to do with investing, but it was a business. I did that for about 20 years. And by the time I was about 38 or 39, I realized at that age that we don't need to work so much anymore. Um, in fact, it was almost like I had a calling that I needed something different with my life. Just like I was a workaholic. I consumed my life. I worked and worked and worked and worked. And of course, the byproduct of that work was I was able to save a lot of money because you're working, you got to spend it. And consequently, I taught myself to take that money that I was earning and invest it. And I relate to you as individuals in society because it seemed like there was like this blue wall that was up. Like there were people who knew how to invest my money for me. They really didn't want to let me know how I do it myself. And so it really motivated me to, I gotta learn about this stuff. If other people can do it, I can do it. And it was about this time where there was a guy on the radio at that time named Bob Brinker. And I think he's up there in heaven now. But Bob Brinker was a true inspiration to me because he had radio show was on Saturday and Sunday. And he talked about investing. It was a call-in show. People asked him questions. He shared his personal experience as much as I'm going to do in this class about investing. And I started to realize by listening to him that I could do this. Because up until then, I really didn't seriously invest. I mean, I had money in the bank, and I was buying savings bonds, CDs. I understood it and stuff. But really, the stock market is the wealth building tool that's available to you was just intimidating to me. I mean, how in the world do you buy a stock? Where do you go? And like, what makes one stock better than another stock? My perception, as most people's perception of investing, is it's really complicated, and you gotta do your research and you gotta watch it. Well, I learned from like Bob Brinker and reading books, a guy named John Bull, who is the founder of a mutual fund company I currently use called Vanguard, who wrote books about investing. And one of the classic books that I would highly recommend. They have it in the library here, but there's numerous editions you can get on Amazon for relatively cheap. It's called Common Sense on Mutual Funds by John Bogle. And he even has a little one, which is it's a simple version of it, but it's a tremendous book, giving true insights into investing. In fact, a lot of the charts I show have been plagiarized from these various books. I mean, I would see these charts and the information is so good, and I've used that in my classes all these years. So basically, what I'm saying is, I taught myself how to invest, and so I would say right now, by a very young age of my late 30s, I realized they didn't no longer need to work. Another asset I had is I wasn't married. So I'm not strutting my stuff out. I was like, oh, this guy, how do you ever do that? I wasn't married, that's an expensive proposition. Um, but I am married now, and she's great too. But I bypassed that doing it young where it really can set you back financially. But anyway, that's another story. That kind of shortcut. So anyway, uh, I eventually sold my business. I said I just feel like all I need to do something different with my life. And I moved back to Oshkosh where I grew up. And I actually had a teaching degree. That's what I went to college for. And I started getting involved because my sister had a couple of kids at Shiro at that time. And the principal running my sisters and asked me if I could come into the school and like help a little bit with some of the kids that were advanced in needed a little more care, a little more tutoring because they were so advanced. And so I started working with kids, and I thought, wow, I can't believe these kids like me. And it was like magic to me because even though I went to college and I student taught and all that kind of stuff, but then it was not nearly me as actually doing it for real life. And I just couldn't believe how the kid responded to me. And so then one day I asked the teacher, well, do you think I could start teaching them about money? Because we're dialing back to the 1990s. What I saw happening in America was basically a financial travesty. Uh, we had such prosperity, and the stock market was just going bonkers. And I was looking at how people were behaving with all this newfound wealth. That was at all kinds of people were borrowing money to put it into the stock market. There's all this stuff going on that was to me so financially irresponsible. I thought, like, I got to share with kids about being like my parents shared with me about being smarter with money, some of the basics of it. It was from that you know, kids talking to parents, and then parents asking me, why could I do this if you could tell me about investing? I could understand it too. And that was the light that led to those classes way back in the 1990s. And there's only one reason why I do this, or two reasons why I do it. Because I like to. See, this is so awesome about being successful financially is successful financially every day you choose kind of what you want to do. And it's been such a blessing to me for the last almost 40 years of my life. I have fun every day. When I would do the classes at the high school, because I would go to Oshkosh, do personal finance classes, and I'd introduce myself. I'd say, you know, I'm like a teenager, only I have money. When you're a teenager, you know, you got all this world and you can support it. You do all that kind of stuff because basically your mom and dad are footing the bill for most of this. It's awesome and it's so worthwhile. So anyway, this class is something that I really, really enjoy doing. But the other thing, as I said, I love doing it because how I guess this is a byproduct of what I learned from my parents and what I learned from my grandparents. Is there's just this wonderful feeling of being able to help others better their lives. And so I continue to do this because I get so much feedback from people who have come to this class and they see me on the street and they thank me because they think their life would never be as good as it is right now if I hadn't come to your classes. And what more motivation do I need than that? There's certain things that money can't buy. So this class basically is trying to help you to make better choices with your investments. If you want to do all your investments yourself, I think it's very doable. You might take this class and say, you know what, I love what I learned, but it's just too intimidating. I get it. I'm not telling you you have to do it, but I think if you go to all the classes here, that you have at least an insight to the fact that investing is really simple. It is. As Warren Buffett said, investing is really simple. It's just not easy. And why isn't it easy? Investing is really difficult because it involves human beings. We are tremendously complicated people. And we are basically genetically programmed to fail at investing. Our basic emotions contradict what it takes to be a really good investor. We work really hard. We sacrifice. Well, first of all, what's the value of not spending money? What a bummer. You get out there and you earn some money. It's like, oh yeah, I'm going to invest. I might make money in the future, 20, 20, 30 years from now. It might be a lot of money, but you got to wait 30 years. First of all, we don't like waiting, do we? We want instant gratification when it comes to money. And you get instant gratification when you earn money, you buy things you want. And there's nothing wrong with that. But it takes a higher form of thinking to say to yourself, hey, I want this, but long term, if I don't spend this money now and I put it to work for me, man, I can have things I never dreamed of that I could afford somewhere down the future. That's what this class is all about, is the fact that it is normal by you. There's so many ways to invest money. And if you're interested in creating stocks, cryptocurrency, derivatives, shorting stocks, puts and calls, all this other stuff that goes on, this class is not for you. Because investing that way is work. And I have more important things to do, like, by the way, so many people think about getting older. I'm going to tell you one good thing about getting older. It's way easier for me to shoot my age at home now. Like when I was 40, there's no way that I'm going to shoot a 40 in 18 months. Because in your 70s, it's doable. And every time I do it, I feel really good about it. Okay, so what is this? What is this way that you can learn in this class? I'll get into this more because eventually, as we get into like the last lesson, I really will share with you exactly how I invest my money, which is really how you can do it very simply. But you won't believe this. But basically, my entire portfolio consists of 2 mutual funds. 2 mutual funds. In fact, you can be a tremendous investor and seek tremendous diversification if you're just using one fund. And you're going to get into that. There are ways to do that. But I just use 2 funds. And I have as much diversification as anyone in this class, as far as exposure in the stock market and really tremendous diversification in the bond market. So what are these funds? I'm not going to tell you today. I will probably mention it numerous times because I can't help but mention it. But you will learn in this class about this approach of simply owning the stock market. So many people, when they go into investing, they have a goal, or they don't have a goal. In other words, it's just a random thing. I mean, a lot of people just say, man, if I just make some money, I'm happy. And so they don't have like a measurement of systems. I do. In fact, I have a strict criteria of performance. And my strict criteria of performance is I want to make sure that the money that I have invested in the stock market earns every penny that the average return of the stock market is. So how can you do that? Well, you can try to pick stocks that will mirror the return of the stock market. Maybe you can beat it. You can pick different mutual funds and try to do it. But what I do is I simply buy the whole stock market. You as an individual have the ability to own the whole United States stock market with just one investment. And not only can you own it, but it'll cost you almost virtually nothing in expenses every year to own it. It's unbelievable. And the other choice is on the bond side. That's another asset in this strategy of investing, because you don't have all your eggs in one basket in equities, because there's a lot of risk to it. There's a lot of volatility. In fact, I read a really interesting observation, how do you measure what is success? Success in investing is getting a return like the stock market without excessive volatility. Managing your money, getting a strong return without extra risk and so forth to do that. And that's kind of what I do. It's like I've eliminated so much risk in investing. And we'll get into some of those risks that go over and above economic risk. So as I said, I have a goal. And ever since like the year 2000, I really reorientated and really refined how I approach investing my money. Is I have a goal of what I want to do with money as far as returns to measure being successful. And it has to do with a principle of investing called reversion to the mean. So look at various economies around the world. Every country has a long history with their markets done. And markets have more potential for average return than others. And the States is a pretty mature economy. In other words, we have kind of a potential return that is kind of, we revert back to that average return. And it's based on our ability to grow. Combination of growth rate and inflation rate and stuff like that. It's kind of complicated. It's amazing how it reverts to the average, much like temperature. I like to use metaphors. And I think back to August. Remember how cold it was? I mean, I was wearing long pants when I took the dogs out in the morning. I'm thinking, wow, this is like 62 degrees and it's August. It should be 80. And it was really cold. So we were like 20 degrees below normal. And now, December. Now we're 15 and 20 degrees above normal. But if you look statistically and you look back in the last 100 years, it's amazing how average return comes up. And that's why we measure, but it's just like that. It has big swings up and down, but there's an average slope. Myself, I long-term for this return, which just basically gives me like patience. Because I know that over time, markets return average returns. And if you look at the various markets that I'm talking about, you have the stock market. This is 1926 to 2007. You can extend it all the way up to now. And you'll see that stocks have averaged north of 10%. And if you look at bonds, it's about 5%. And that's like intermediate term bonds. T-bills would be shorter term, that's 3.9. And then cash, somewhere around 3, something like that. Yes. Oh, yeah. Why don't I pull this forward? How's that? I should put the top on. Hopefully this. I had this out in the garage and it rusted, so here, that should keep it. So basically, this is markets. As an investor, this is what I'm happy with. This is what I've achieved. And I achieve it because I actually buy the markets. And this is to me. So one of the things that I've learned to be a really good investor is that you have to be humble. In other words, I'm no better than anybody. There's people that I gotta get a better return. I deserve it. I work hard. I'm a good person. I should get a better return than now. So, I mean, the crazy way we think. In other words, I don't want to get any better than someone else. I just want to get what the markets are returning. And it goes this way too. If the market goes down 50%, as it did in 2002 and 2008, guess what? This money that I had invested in the stock market went down. The portfolio didn't go down because this asset right here actually went way higher in return than that. And I have what's called a balanced portfolio. So looking around this room, a lot of people in here, and these guys over here, should have like balanced portfolios. It's like with a balanced portfolio, you have a combination of both of them, kind of like an equal amount involved. And so one is doing really good, the other's doing great. And so the overall output is not that great. And when the overall volatility is bearable, you're patient enough, you don't have to be checking it all around. I often say I spend less time on my investments this year than you spent brushing your teeth this morning. And it's not that I'm lazy. It,
When I couldn't see which was the two that you used.
well, I use a stock and bond fund. Otherwise, you won't come back. There's a teaser here. How this works. No, it's no secret. So, if you look at this idea of trading and time market, because this is what I see so many of the ads. There's one, I won't name the company, but it always drives me crazy because they spend a lot of advertising, and their catchphrase is, "We only do better when you do better." Well, you know what that firm does? Is basically, I don't know exactly what the fee is, but what they do is they take your portfolio and they manage it for you and have a set fee. So of the percentage that you have. So naturally, the more yours grows, the more fees. But what you're going to learn in today's lesson, paying that fee. If you didn't have to pay that fee and achieve returns that average market returns in the stock and bond market, you're going to make way more money than you would pay that fee. Hopefully, by the time you leave this class, you'll understand just how much 1% is. 1% doesn't sound like much, but when you're coming to invest, it's huge. 1% in investing is like you driving around with your car with a little hole in it in the tires, each one of them. Your gas mileage is going to be going down because you're leaking. So anyway, this idea of being patient is, and one of the things too that helps with this class is, and this is my experience. is the more you understand about what you're doing, because what you're doing is simple, and you understand how you have your money invested, and you have history behind that, what you're doing, meaning your asset allocation, the more patient you become. What gets us to, as I said, as human beings, we're programmed not to be good at investing because when we're scared, what do? We run, don't we? We act. We think we have to do something because if we don't do something, we're going to get eaten up by the tiger. People think of that in investing. God, if I don't do anything, I'm going to lose all my money. What am I going to live on? So the more information you have, the more knowledge that you have about investing, the more patience you have. This may sound really crazy, but it's been a while since we've had a really nasty bear market. We're driving back to 2008. If you look back in the last 25 years, 2008 and 2002, to me, those were tremendous opportunities to do really well in investing. In other words, big sellers, if you're paying, actually are big opportunities. It's contradicting what most people think. You're going to get that from this. So understand what I'm talking about through asset allocation and market adjustments to building to the future. So this idea is Vanguard has a thing called stay the course with your investments, provided that your investments are set up the right way. And if you look at the bear market we have in 2008 going into, so if you fast forward to 2016, if you would have put your money just in cash, you would have a total return of 1%. If you had put your money into bonds, you would have had a total return of about 38. And if you had a mix, it was just kind of like a balanced portfolio of 60% in stock market and actually got the return of the stock market and 40% in bonds, you would have a return of about 117% in that short time by not panicking and keeping that money invested. That's staying the course. Another chart showing exactly what I'm talking about. You take 1980 to 2008. So if an investor missed the 10 best days over the past 109 years, he or she would have missed 2/3 of the stock market. So we're talking about 10 days over 109 years, and it would have cut your return down by 2/3. In spite of what they say on TV, in spite of whoever you're talking about or to in the financial service industry, if they tell you they know the stock market's going down or it's going up, they basically, they're fibbing. No one knows. There's a great book, another one. It's called A Random Walk on Wall Street. And he just, it's a, investing a random walk. Long term, when you're talking 10 years, 20 years, those returns I showed of 5% in bonds, 10% in the stock market are extremely predictable. But on a day-to-day, month-to-month, week-to-week, even year-to-year basis, it's unbelievable. It is. It just simply is. So why try? Because if you screw up, I told you, I've been doing this for a long time. And I've, I've seen it so many times. Back in that bear market of 2002, there were so many people that I was going to senior centers back then. And there were so many people that were in their 70s and 80s that had portfolios of between 300 and $1 million. And within a month or two, they were down to a couple $1,000 left in their portfolio. Why? Because they had their money managed by someone who simply put them in all this crazy stuff that chased the performance of the tech sector back then, communications, the internet, all that kind of stuff. And yeah, they were doing great for a while. But when that bear market hit, they virtually had their lives changed. And they came and were sitting in this class. And they learned about investing from me. And they there was nothing I could do to help them. It was gone. And they had relied on professionals who took a hands fee to give them advice for that. That really, really motivated me to do what I could to prevent that from happening to other people. Because this idea of chasing the hot stuff is extremely risky. It's extremely risky. And usually you end up getting burned. Just, I was looking at like on my Yahoo finance, like I'll check the stock market every time, and those two funds I talked about that I use, the intermediate fund and the total stock market index fund. There I said it. Okay, and so somehow the computer automatically shows me stuff. And right above it, it showed me like the top 5 performers of the day. And I happened to just glance at that. And at the top of it was a company called Wolf Speed. What the heck is Wolf Speed? But so far this year, Wolf Speed is up 1,200%. And it's $2 a share. so think about all the money that somebody made. So let's get out there and get on the train. Whatever. And it's like that's what people do. They see that and like something. They bought that at the beginning of the year, made 1,200. I want to get on it now. We'll see how Wall Street does, in the future. But this is that's human emotion. Man, look at the opportunity here. It's like a gold rush. You can't think that way. Okay, so fundamentally, to me, the most important thing that you need to do to be really successful at investing is as simple as this. Maximize what you're doing with your money. Maximize the compounding. Because compounding is, as Albert Einstein said, it's not the atom. It's the most powerful force in the universe. And it is. And people just take it for granted, but it is an enormous economic force. And by compounding, I simply mean that it's the ability of an asset to generate earnings from its own earnings. So if you have $10,000 invested and you get a 20% return, and it's a $2,000 return on that. So instead of having fees, taxes, and other things subtracted from that, spending it, you take that full 2,000 and you find ways to reinvest it The next year you go in with $12,000. You get 20% a year. You're making 20% on not only the 10,000, but the extra 2,000 that you reinvested. In other words, investing is like building a snowman. Start out with maybe just a little ball, start rolling it. And it doesn't seem to go that fast, but then the farther you roll it, it starts getting bigger. And then when it gets bigger, it gets heavy. Each time you roll it, it gets to the point where you almost doubles in size every time you turn it over. That's investing. That's the way I do it. But there's a trick to it because there's three elements to it. It takes time. In other words, investing isn't a, and that is once again human nature at its best. People want results now. They want to make the money fast. And if you do that, it is possible. But you have to be, it's extremely risky, and the probability of success is very, very small. I always think of investing this way. For people who are out there actively pursuing returns on their investments, for you to make money, someone else has to lose. In other words, for you to make money, someone else has to lose and be selling those shares because they sold you the shares and it went up and you lost because they sold it. It's the way it works. It's the way the world. So basically, in compounding, there's three elements. One is time. It takes time for money to compound. Two is fees and expenses that deduct from compounding. And then there's taxes. So we're going to get into, I'm not going to spend a lot of time. I will talk about investments later on that you can invest outside of IRA. A lot of people here are retired. You don't have IRAs anymore, but you can invest in retirement plans to put in because you're not working. There are very good investments you can put, very tax efficient, and we'll be talking about to help with that component. But these fees and expenses, most people have no comprehension of how much fees and expenses can deduct from your long-term ability to build wealth. Okay, so what motivated me a long time ago to start investing? I think I was in high school where I learned this basic principle. I show this to the kids in high school all the time because for me, it gave me this incentive to harness this like concept that helped me to motivate me to save money and invest it. You'd like to have some idea of what possibility over time with this. So it is called the rule of 72. So investors should know this. So basically, the rule of 72 simply states that you take the number 72 and divide the rate of return of your investment into that number, and you get a pretty idea how long it'll take for your money to double. So if you look at the reversion to the mean and you invest in something like the total stock market index fund and give it a long period of time, and by that I mean 20, 30 years, you're probably going to average around 10.2%, and somewhere around there. Meaning over a longer period of time, right? 25 years, 10 years, you're going to roll almost double about every 7 years. And so if you take 2% from that, that is every 9 years. You drop that down to 6%, it's 12 years. But you get some idea of how long it takes for your money to double. So the primary asset that I use to invest in, as I said, I'm not interested in buying stocks. Here's why I'm not interested in buying stocks. Because if you're buying stocks, it is a lot of, it can't, well, if you're actively buying stocks. I know people that, oh, I was 2 years old and I bought in, I still own it now and I'm 60 years old and it's worth half. Well, great, because you must have just forgotten about all volatility. So, and congratulations, because if you have $500,000 in Intel, all your money's in Intel, you better sure hope Intel doesn't run bad buttons because you have all your money in one place. It's extremely, you might have been really successful in what you, but that success can evaporate very fast. Because the longer a company exists, the more chance there is that a competitor or other forces are going to eventually bring a demise or, really hurt that stock. So that's called specific stock risk. What I like to do is use a force in investing that really helps me, once again, reduce volatility, reduce risk of what I'm doing, and that is diversification. Diversification is a great tool, not only in investing. So the more, if all you do is one, life is pretty boring. You like diversification. You like to do different things. So I love to golf, but I like to ride my bike. I love walking my niece and nephew's dogs. I like this and I like that. There's like a lot of things I like to do. Diversification. You like to have a variety of things. In investing, diversification is spreading yourself around into a variety of different companies. There's so many different kinds of companies in the stock market. So when you talk about investing, by the way, I wrote this down here. I forgot to mention this when I started the class. You can stay in touch and ask me questions through my Facebook page. It's like people, it used to be like when I first started using these classes back in early 2000s, people actually called me. Yeah, people talk on the phone. Yeah, I mean, it's like it calls all the time. It's like we've evolved that it's too hard to call together. And unfortunately, I have a flip phone, so you're not going to text me. But you can ask me questions. And through either of these two Facebook pages. One is Adventures in Investing Facebook, and the other one I just did Kemp. A great picture of one of my niece's dogs. So there's different types. So you can message me on those. Okay. Let's see. I remember one time I grabbed one of those markers and it didn't work out really good that class. So I was talking about diversification. So what I use is what a vehicle which most people use, which is mutual funds. So a lot of you have your money in mutual funds. They may have been a product of the mutual funds you picked when you were working at your company. Could be you have a financial planner that put you in various mutual funds. So most people have no concept of how a mutual fund actually works. They just know that they put the money in there, it goes up or down. So basically you should have a concept of how this works. And why should you have a concept of how this works? Because by having a concept of how it works, you'll get a good idea of what you're actually investing in. But you'll also get a concept of the expenses that you're paying to invest through that financial product. So basically, I have a chart here, kind of just, I put it in a pie chart. So basically, a mutual fund is a pool of stocks, a pool of bonds, a pool of stocks and bonds, depending on the objective of the mutual fund. So all mutual funds have an objective. So basically, what the objective states is how the manager of that mutual fund will invest your money when it comes to the stock or bond market. So you'll have mutual funds that invest in small companies. So the fancy term is small cap company. That does not mean that the manager wears a cap. That means capitalization. So if you want me to spell that, I can't even pronounce it right. Don't ask me to spell. Cap with a dot works. Okay, so what does capitalization mean? Okay, so we categorize companies by the value of those companies have in the stock market. It's a very simple computation. You'll take the number of shares of a company. So all companies have a certain number of shares outstanding that the general public is holding. So take the price of that, that stock. So let's say the stock is $10 a share. Now we'll take the shares outstanding. How many are there? So it's called a float. So if there's 1,000,000 shares outstanding, then you would multiply this out, and the market capitalization of that company would be $10 million. All of that? Pretty simple. So it's the number of shares that are being traded or held by investors times the share price gives you the market capitalization. It's not necessarily the value of the company because that's called book value. That's different. But for investment purposes, the market capitalization is the way you categorize how that manager is going to invest your money into the market capitalization of how those companies fit into those categories. So you'll have small cap, and small cap is like up to like $3 billion. So numerically speaking, there's way more small companies in America traded in the stock exchange market than any other company. It's not even close. However, if you look at our stock market, and we use a pie chart to do that, that small companies only make up roughly 10% of the whole stock market, of all the money that's invested in the stock market. Only about 10% actually goes into small companies. So if you look at a mutual fund and it says it's a small cap mutual fund in your company retirement plan, it means you're investing in a smaller company and roughly of the market capitalization of the whole stock market is only a small part of it. So you lack a lot of diversification. Okay, then there's mid-cap companies, and small cap is 15, they're about 10%. So mid-sized companies are 3 billion to like 10 billion, something like that. I don't know what fits. We'll use that number. But then look at the large cap. So it is mind-blowing how much of all the money that's invested in the stock market is concentrated into about 500 companies. There's of the tens of thousands of companies that are publicly traded, these 500 companies, most of the money, or 75% of the money, is invested in these companies. So basically, what I'm trying to explain here is when you look at your selection options in a company retirement plan or your financial planner creates a portfolio for you, and it says small cap fund, you're investing in these. If it's a mid cap fund, it's these. If it's a large cap fund, it's these 500. You have a manager who's picking from that universe, and his objective is to create value for you. Financial, your local financial planner doesn't pick the stocks for you. He picks managers, and those managers go out and actively buy and sell stocks in that universe to try to create value for you to get a return. Okay, there's another way we break down these mutual funds. We have growth mutual funds, and we have value mutual funds. So you have small cap growth, small cap value, mid cap growth, mid cap value, large cap growth, large cap value. Growth, to kind of give you an idea of what a growth company is. A growth company, I mean, there's lots of different ways, but I'm going to use my own definition because it's kind of an observation, is oftentimes produce things that we want. Like we really want. We want an iPhone. Usually they have the ability to grow really fast. People, when they have money, they buy things they want. But then there's companies that even we're not doing so well financially, there's things that we have. Those to me fit in more of the value companies, kind of like companies like financial service, healthcare companies, gas companies. It's like you got to get to work, so you buy gas. You know what I mean? So as this universe of investing, this is what mutual funds invest your money in. And they work like this. Money comes into a mutual fund. So if this is a large cap growth mutual fund, so we got a certain number of companies in the S&P 500 that are considered growth companies. Okay, so the manager you would send money, and the manager would take the money. And there's only one time of day that your money actually gets invested. That is after the close of business day, Monday through Friday. So what a mutual fund does is people have invested in it. And when people invest money in a mutual fund, your money is pooled with other money. All mutual funds have an NAV, or net asset value. The net asset value of a mutual fund is take every stock that mutual fund has, number of shares that they have, close at 3 p.m. when the stock market closes that day, multiply the number of shares of each company times the share price, and they get a gross value. They deduct expenses. Now, expenses are things like transaction costs. So the manager was buying and selling stocks throughout the day. Every time he does that, there's a fee to buy stocks, and there's a fee to sell stocks that he has. Then, all mutual funds are owned by corporations that have shareholders, except for one. Which one that is? Vanguard. Vanguard is a mutual fund or financial service company whose mutual funds are owned by people who would invest in the mutual funds. So with a Vanguard fund, the fees deducted don't cover or will not be over and above the expenses running that mutual fund, accounting fees, stuff like and there has to be a manager who gets paid. But all mutual funds have a business plan in which management fee is deducted to pay the manager to make a profit for the shareholders. And there's another expense, which I'll talk about later, 12B1. So basically, it's as simple as this. If at the close of the business day today, the mutual fund that your financial planner or you plan to invest in has an asset value of $10, and you send your $100 to it, your $100 will get added to this mutual fund. And exchange, because the share price is $10, if you gave them 100, you get 10 shares. Simple as that. So money that comes in does not make the share price of a mutual fund go up. The only thing that needs to go up is the difference between the value of the assets in it and the shares that it is. That's why when you send money to a mutual fund, you can take your money and then invest it at 12 o'clock. Because they have, there's a certain number of shares. You can't be doing that and that rapidly because you can't calculate that fast for all the different stocks you have. So there's another asset you can invest in too called an ETF. That's for another one. Basically, most people through the company retirement plan use mutual funds. And mutual funds are tremendous investment vehicles for people to use. It's really interesting because last night I was watching a particular show and they kept coming up with commercials. So I decided I had a book that I bought a long time ago about investing. And I went to a chapter and it was talking about if you went and bought, I think, the Dow Jones Industrials. If you bought one share, that would be total 30 shares. Each company, you bought one share of the 30 shares for $1 average back in the 1950s. What do you think the commissions would be to buy 30 shares? I think it was over $1,800. So mutual funds were created out of the need. So allowing the average person to money and get more efficient access to the stock market at a lower cost. Simply put, that's what mutual funds do. Okay, but there's been an evolution in mutual funds because not only do you have the choice of small cap, mid cap, large cap, growth, value, that would be active choice of investing. So what I'm talking about there, of picking a manager who's going to fix the universe, that's called active investing. I don't do that. Well, I kind of do it with my bond fund, but I don't do it with the stock market. Because along about 1970, a man by the ones that I mentioned it before, by the name of John Bolton, was just a young pup back then. And he had been working for a company called the Wellington Company. He made an observation. He made an observation that all these professional managers of these mutual funds that existed back then, like they were really smart and they were really good. Yeah, I mean, it was a lot less expensive than an individual buying stocks. But it's still, when you took into account the expenses that mutual funds were charging their investors, that most investors just like weren't even getting their return to the stock market. Basically, because the expenses were so high, they were not getting a return. So what he did is he created, well, back then they called it Oval stock. It was like Stewart when he bought Alaska. That was like really, it was Alaska. Stewart's folly. Look at Alaska now. Those Russians, they want it back. But anyway, that's another story. But back then, Tom Wolfe said, you know what? I want to create a mutual fund where, these 500 companies, there's actually a company called Standard & Poor's that leads out the 500 biggest companies, representing all the different industries in America. And they create an index, a basket of companies. So this word index means a basket of companies representing a portion or all of the stock market. So you hear that word index, that's what we're talking about. There's small cap indexes, mid cap indexes, most indexes, value. There's indexes. He said is because most of the money that the stock market is invested in these 500 companies, why don't I create a we buy the 500 companies, we don't trade them. We allow investors money in, comes in, we take the money and we spread it out to 500 companies and their portfolio, and that's what we do. So we don't have to pay a manager buying and selling. We don't have all these transactions. So what we can do is we can really lower the expenses of access into the stock market. We can create a whole different approach to mutual funds, where rather than actively trying to beat the stock market, what we'll do is we'll just get the return on the stock market because we're owning all the stocks in the stock market, and we're doing it at such a low cost that the impact on the total return of that is significant. So this approach to mutual funds, you have a choice. You can go the active route, and the attraction of the active route is it's attractive to you because you compete the market. If you have skill and you have all the power, you can beat the market with an active fund. When you use an index fund, you can't. The other individuals or institutions that active management buy them to you because of the expenses that they're generating, the profits that are making from them. So, does that give you some idea of a mutual fund? It was really interesting because I no longer one of the motivations for me to get smart about investing. I was in my 20s and I learned about bonds. And so there was this company that had bond funds, and it was advertised in Money Magazine. It was really Money Magazine back then. And this bond fund invested in municipal bonds. Because they were municipal bonds, meaning bonds issued by the state municipalities, all the interest was federally tax free. What? I thought I died and went to heaven because I'm paying all this money on the interest that I'm making in my CDs, my savings account. Because back then, I was investing in CDs that had 10% interest. It was great until the end of the year came and I got taxes on all this. Wow, instead of buying CDs, I could invest with one and the interest was a little less than CDs, but it was still very attractive. So one day, I started investing. Now back then I had no idea that there's something called lows and no lows. See, I didn't know that you could invest in a place like Vanguard, Fidelity, or Hero Price, where you actually give them $10,000, and the whole $10,000 is invested. You don't have to pay up front. Well, this Franklin County had a five, I think it was like a 5.75% loan on it. Well, I figured, I had no choice. I got it invested. I didn't know about Vanguard. I didn't know about these things. I was just getting started. So I was sending money there every month and I paid a certain amount of it. So one day I said, how does this thing work? Nobody ever does this, but I did. And you get your statement. I go, okay, I got X number of shares, and here's the share price. Oh, I got $300 of that month. Okay, 300. I reinvested the 300. You reinvest the interest. Okay, so then I looked at the next line. Reinvested $300. So let's say the share price back then was $10. So, math major, I figured out if I reinvest $100 and the share price is $10, I should get 30 shares, right? Follow me so far? Didn't lose anybody? Okay, good. This is higher math, and we're getting up there, but I hate to stress you, but it was pretty simple computation here. And I get 30 shares. I got like 20 some shares. And I thought, what am I missing? I can't understand this. I can't. It should be simple math. So I called the company, got a lovely lady on the phone. She was so nice. And I explained it to her just like I explained to you. I said, how come I didn't get 10 shares? And she said, that's the load. I was taken aback. Seriously, my ears turned red, and I got big ears. They were red. My blood pressure, I don't know what it went to, but the thought of getting charged money or reinvest money just really blinded me. I thought, only a sucker would do that. That would be like going to the bank, then, oh yes, you got $200 interest. However, we're going to keep $20, and you get 180 because we have expenses. So we're going to keep that money. You wouldn't go to that bank, would you? I thought, this is crazy. I have to learn how this works. And that eventually led me to find about no mutual funds. Okay. So do you get this? This is why I can relate to all the people in this class. Because I wasn't born a genius in finance. It's all the experiences and the knowledge that I've acquired through things like that to teach me to be smarter about handling this stuff. Because it is really like a street fight. It's like going to the south side of Chicago. You better know how to navigate it. Because there's sharks on every corner when it comes to investing. And seriously, there is nothing that morphs human behavior to the negative more than money. And fees and expenses can be just manipulated and twist people around with just too crazy expense. So basically, that got me on this road. Fortunately, companies don't do that anymore, but back then they did. They just found other ways to get your money. Okay? So let's just talk a little of these. I won't add a whole chapter on these expenses, and I wrote a few of these. Go into all of them because it gets like twist your brain. You have funds that charge a low. That's a front end fee to invest in their mutual funds. There's funds that charge a back end loan. In other words, they don't charge you upfront to put money in. But then when you take the money out, they'll charge you a 5 or 6%. It's a lot. There's purchase fees. There's exchange fees. There's account fees. Man, if you're with a company, account fees. It's just like, anyway. There's redemption fees. Trust me, there's so many people that have taken this class and then get their money out of wherever they had to move their money to Fidelity or Vanguard. Oh, well, we're going to have to charge you like to do that. They were all sweet and nice to put the money in there, but as soon as you want to get the money out, they hammer you with a fee. Just ridiculous, absolutely ridiculous. Okay, the management fees, which I just talked about. And that covers paying the manager and it covers the margin that they need to make. 12B1. If you don't believe that, number one, when it comes to a service company, is, and then because it's a fee, it's one of 12B1. And somewhere hidden in that little brochure that you got a investing is a prospectus. A 12 would be a 21 fee that mutual funds charge so that they get advertised. So you see the one company of a thing, something about how much it costs that company to put that on that national football game or something like that. Hundreds of thousands of dollars. From people who are investing in their mutual product. OB1 fee was extracted and advertised to sell their stuff to someone else. How does that add value to what you're doing? To be very well aware of. And then there's transaction fees, there's costs that cost about that can be complicated and stuff like that. And market impact costs, management and it drives up the price. And as the price goes up, he buys more shares because he chose to buy those things. There's so many things that managers do that will influence the price of things from a negative view. So basically, and then there's rack fees. So these are just some to give you some idea. This is but how much money Americans have paid. The management fee is roughly that probably what would be over on average over 0.5% back up in 2008. So you're talking billions of dollars. 2009 was 28 billion. I can't imagine what it is. I can't imagine. So be aware of that. All right, let's compounding. I said time is really important. So I'm looking around this class, and we do have some younger people here. Okay, I love this story because lady that came to my class a long time ago, a young couple, and they had she had a great grandma, and this is back 20 years ago or 15 years ago, and great grandma won money in the stock market because her name was Sarah. They were putting money in it, and they would always tell great grandma how much the investments are. So great grandma had all this money in the bank. Grandma was like in her 80s. Great grandma said, you know what? I'm making nothing because we're talking about thousands when interest rates are zero. I want to take some of that money and I want to put it in that post office. And Sarah said, oh, great grandma, this is because we're young and it can go on, but we're going to hold it for a long period of time. Great grandma, you're in your 80s and you could put that money in there today and it could drop and then you'd feel really bad. And she says, oh, okay. So 10 years went by. Great grandma's now in her 90s. And over that 10 years, she was paid virtually no interest on that money she has in the bank. She said to Sarah, hey, I listened to you 10 years ago. I have nothing in that money in the bank. I'm going to take some of that money and put it into the next one. And she said to Sarah, and Sarah said to her, but great grandma, I told you it could go down. And she, oh yeah, that's what you were 10 years ago. So this whole idea of time is we don't know how long we have. So you have to invest as if you're going to be that lady about to be 100 years old. You just have to look long term. So this shows you the power of time. You have William, who has started investing when he was 20 years old, extraordinary young man. He was $4,000 a year into an IRA. So he does that for 20 years. And he gets an average return in the stock market. So this is like an index fund of the stock market. Averages 10%. And if he has it inside his company retirement plan, it's called taxes. Low expenses, tax efficiency. He gets to be 40 and maybe he has some children that are getting close to college age. He wants to maybe pay off the house. He wants to maybe get his college education. So he stops investing. He just lets it grow. He needs to be 65 years old. $1,000 a year for 20 years. And return of 10% is compounded out to $2.5 million. Now, he has a brother named James. Now, James is a typical guy because most people don't get serious about investing until they're at least in their 40s. So James starts doing the right thing at 40. And he talks to William. William directs him to this great investment that gets the return. And James does it faithfully for 25 years, 5 years longer than his brother. So he invested an extra $20,000. When he turns 65, his portfolio is less than $400,000. How people waste those precious years of compounding? Time is so important. And I see a lot of people nodding their head here. You have people in your life. You need to talk to them about this stuff. You can influence them. I'm going to get into this later when I talk about how you can set up your own money and some tips on how you can help people to get into the market, to get into setting up a portfolio. Maybe you have enough money to help them with a little bit of money to get them started. Because just get them started at a young age. Is that first step is the biggest. Really, I have young people we can influence that way. Okay, so let's talk about the impact of fees. Because as I said, this whole thing about investing in mutual funds can be as complicated as you want. You can go out there and chase managers, you can chase all kinds of sectors, do all kinds of stuff. Or you can simply do it low cost way like I do. You get the diversification of the stock through an index fund. But let's look at how these fees and expenses impact you as an individual. And you will realize how much expenses dictate ultimately your ability do you want to go financially? And if you're already retired, to keep the money, make it last. Okay, you had $495,000 in a portfolio and you invest it over 20 years. So let's say you're retiring at 65 and you live to be 85 years old. That's a 20-year period. And you probably with a balanced portfolio. I'm talking about bonds getting 5+%, stocks getting 10, maybe the stock market will get 20 or 10, right? So average should be north of 6%, but you got 6%. Okay. Okay, if you had a management fee of $1. So another investment term that I will use that you need to understand is basis point. So a lot of you have been exposed to that term if you bought a house. If you buy a house, you go in and they tell you the expense of the interest is going to be 475 basis points. What they're saying is 4.75%. Each represents 1/100th of 1%. So investing 1% is 100 basis points. So you go to the mutual fund I was talking about at Fidelity, Vanguard, Schwab, you can invest at 4 basis points. If you have a company retirement plan with a really good company, I've seen people that have expense ratios as low as 1 basis point. It's amazing how low expenses can get. So what's the difference of taking a set amount of money, a set period of time, a set return, and the influence of expenses? If the expense ratio was 10 basis points, the expenses to invest this over 20 years would be 31,000. And if you had a half a basis points or 58 basis points, it would be 174,000. It's a difference of $142,900. However, it's much worse than that because we're talking about compounding. You understand everything that's extracted from your portfolio on any given year doesn't have the ability then to be reinvested to grow again and compound. That is the biggest hurt. This hurts enough, but it's the compounding on that that's even has more magnitude on wealth being lost. If you have $100,000 invested for 25 years and you have a 6% return, paying no expenses, $100,000 goes to $330,000. Percent, then $160,000 just for fees and expenses out of that 330, the difference between $230,000. I once read in Money Magazine, if you go home today and you look at your prospectus or you ask your financial planner, like I've been learning about these investments. Now, what is the management of my mutual fund? So in the prospectus, it's there. If you have a company retirement plan, I think they have to put that in there to see if you can decipher it. But let's say, I kind of think the average one now is probably about 70 basis points, which has come down considerably. When I first started teaching this class, the average expense ratio was like around 150 basis points. So they call it the Vanguard effect. Vanguard has really influenced companies to get their management fees down, but it's still around 70 basis points. But those Money Magazine says that you take your management fee and then multiply it times 3. You'll probably get the true managed cost of the management fee, including the other charges, the fees and expenses for transactions, and other expenses, meaning the effect of the manager on the prices and so forth. And they've calculated. Now you drove it up to 210 basis points. Very significant difference. Now, when you look at the difference between an index fund, like we invest in, you're talking about 0.4, and there's very little transactions. The real expense is probably around 0.6, 0.06%. Tremendous difference. So another one, 2% you take. Oops, I got that out of order here. If you take a mutual fund and $10,000 invested for 1 year, and each year you invest $2,000. It's a typical young person. And you do that for 25 years. And average 2%. Okay. If your expense ratio is 2% per year, which basically this tells me you're probably paying, even though it says that basis points, you're probably paying close to 2. Your net would be 226. Your gross would be 300. This is kind of like your paycheck. You get your paycheck. Oh man, I did really good. Oh, but then after this, the taxes, the only thing that matters is so you take gross would be 124,000. Your net would be 226. You paid 98,000 in fees. If your expenses were 1%, your gross once again is 324,000. Your net would be 270,000. So that would be better than this, but your fees would be 53,000. If you had expenses of an index fund with 4 basis points of expenses, your gross would be 324. Your net would be 322. Your total expenses for 25 years would be a little over $2,000. Tremendous difference. And it affects the compounding too. Okay. Now this one, I got this on the internet. It was from Yahoo Money-wise, and I got it 1/24/2024. And someone did this calculation. I find it hard to believe. But this chart, because it was on Yahoo Finance. And the guy's name, I can give it to you. He's an investment guy. He did this calculation, and I find this chart on. You got Susan and Jeff. You should have put Marie and Jeff, because that's my wife's name. But in this example, Susan is 48, Jeff is 50. They have a current account of $460,000. So they have an annual advisor fee of 1.24%. So if that's the management fee, you really have to multiply it times 3. You have to include all those other expenses I talked about. So that's the stated fee, but then there's the other fees. And then there's also the fact that there's going to be everything that they extract each year is money that's not compounding in the future. Okay, if this couple lives 35 more years, which is very doable for both of these. Okay, they're $460,000 per couple. Average grows at only 5%. So we're not talking some miraculous 25% return and so forth, because it's a huge amount of money. It is going to come to probably well over $1 million 5%, 72. But 1.24% annual fee will equal in fees and opportunity costs of money that's not compounding because the fees were taken out at 35 years. $863,100. Is that mind blowing? It's it's a street fight. In other words, you're getting information, but most people that information is meaningless. They get a prospectus. It's a prospectus. They get a statement every year from their 401k, and they look at it. Oh, it might say 07 or something by it, but they have no idea. You have no idea because unlike when you buy a car, there is a list price, and then there's a transportation fee to get the vehicle to you, and then there's the setup time. They have to list and itemize everything. With mutual funds, at the end of the year, you don't get an itemized everything. And people would get it. They would be blown away at how much it's cost. And so when that company on TV says, "Oh, we do better," you do better. Yeah. Because the more money you got, the more they're getting in fees from you. It's based on a percentage of your assets inside of it. And give us more so we can even get more money for you. You take a lifetime of compounding, $5,000. After 65 years, $5,000 invested and the return of the stock price is $2.5 million. If there's no fees or taxes. If that return drops down to 8%, it's only $746,000. If that return averages 6%, only $214,000. Are you getting a sense of the power of compounding? Everybody runs out